in my entire career, have rarely seen anybody who is a successful short-term trader over an extended period. It just doesn't happen. It's a very different market. Against the machines in this market, I see very, very, very few. So that's the issue I've got, is like, I don't think trading works for most people over time. Unless you change your time horizon. And I know most people don't want to hear that, but that's the reality. I don't think trading works. I don't know what investing is like. We don't know what jobs we're going to do. But we're going to have massive economic growth. And I do know that we're very adaptive as a species. We'll figure stuff. And we'll figure stuff in ways of making money, ways of being human, and stuff like that. But we don't know what that is.
Pal, ever living in the future, reveals a profound shift that now obscures his long-term visibility beyond 2030, 2032, a phenomenon he attributes directly to the accelerating impact of AI and robotics. This isn't just about technological advancement. It's a fundamental recalibration of global economic drivers. Historically, Pal relied on megatrends like demographics, observing the pervasive aging of populations across developed nations. This demographic headwind inherently slows economic growth, challenging the traditional GDP formula reliant on population, productivity, and debt expansion. Governments have attempted to counteract this deceleration through aggressive currency debasement and burgeoning debt, creating an unsustainable cycle that Pal argues is nearing its inflection point, poised for a radical transformation.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
The idea that I've had in my mind is my job is to live in the future. That's what macro guys do. And I got to a point because of AI and robotics that I can't see beyond about 2030, 2032. And that's unusual for me because I use mega trends as the backdrop to what I look at, things like demographics. So when you look at demographics, the population is aging pretty much in every major developed country in the world. So that means that economic growth slows as people get older. So GDP growth is driven by population growth, productivity growth, and debt growth. So as population ages, you get these big mega trends that start affecting growth rates of things, and we offset it versus debt. So we've got these mega trends. We've been debasing currency, printing money to kind of offset this massive debt because of the aging population that's slowing growth, and the governments try and keep growth up by creating debt. But soon, we're going to replace that equation because the population side is going to be replaced by AI and robots. So we can have infinite number of productive units population in the next 10 years. So what does that do to economic growth? Who does it accrue to? But we get even weirder outcomes than that. Is, obviously people like, what job am I going to do? What's the point of a trader when you've got an AGI that can do it better? What edge do you ever have? How do companies get priced in markets once you've got this super intelligence? Because don't forget, for the first time in all of history, we will not be the super being on the planet. Somebody will be much smarter than us. It'll be the AI. So it's going to be better at us at all of these mental tasks that we do, and faster than us. So it becomes a strange world where I don't think trading works. I don't know what investing is like. We don't know what jobs we're going to do. But we're going to have massive economic growth. And I do know that we're very adaptive as a species. We'll figure stuff. And we'll figure stuff in ways of making money, ways of being human, and stuff like that. But we don't know what that is. If I know that we're about to go through the largest change humanity has ever gone through in the shortest period of time, i.e. not being the apex of all intelligence, I mean, it's a mind-blowing concept. And you can create infinite amounts of these super brains or super bodies. It's like the only way to really prepare for that is to not care. And the only way to not care really is to have made enough money that your security, you allow yourself to be secure, and then you can enter that world because you can take risks, you can learn, do different things. But if you're expecting to be doing what you're doing today in 10 years' time, you're so wrong. And so really I've looked at this and said, okay, we've got these massive megatrends, crypto, technology. They go up over time. They're the fastest, crypto particularly is the fastest growing asset in terms of performance in all human history in the shortest period of time. So don't this up. Take that opportunity and use it, because if not, you're going to regret it. So I always talk a bit about your future self, and will your future self thank you for what you do today? You're trying to set your future self up to be protected from the new world that comes.
The crux of Pal's current thesis is the imminent disruption of this debt-for-growth paradigm by AI and robotics. These technologies promise an infinite number of productive units, effectively replacing the human population component in the growth equation within the next decade. This paradigm shift raises critical questions. How will economic growth manifest, and to whom will its benefits accrue? The implications extend beyond economics, challenging the very nature of work, investment, and even human identity, as AGI surpasses human cognitive abilities. Pal vividly describes a world where traditional trading and investing models may cease to function as we know them. Yet amidst this unprecedented uncertainty, he emphasizes humanity's adaptive capacity. His strategic response to this monumental change is disarmingly simple. Secure your financial future now, enabling the freedom to adapt, learn, and take risks in an unknowable future. This conviction fuels his "don't this up" thesis, advocating a strategic allocation to crypto, the fastest appreciating asset in history, as a primary hedge against future disruptions.
Okay, so let's say you've got a reasonably fast-moving asset that's proven and is towards the Bitcoin end of the risk curve. Then you know over time that your best bets are going to be to try and buy the dips and then flip them out when it makes new highs, because you've got the skew of the market's directionality. So I understand why you came for the 100x, and that's a statement about what you want out of your life. That's okay, but really you can make your life a lot easier if you truly are trading to make money. A lot of people actually just trade for the adrenaline. It's gambling at that point. And you have to be honest with yourself, is why am I doing this? Am I doing it because it makes me feel something? Am I just betting on the horse racing or whatever it is? Or do I actually want to change my future? Am I doing something my future self will thank you for? It's not going to thank you for that, because 99.99% of people don't make any money out of that. But it's fun. I get it. So what I've always had is this kind of "don't this up" thesis, which is like, if you're going to do silly stuff, do it with 10% or less of your portfolio. And 90% or more, you put it in the highest quality names and let the trend work for you. And it's so hard for people to have a longer term time horizon, because also when you go on crypto Twitter, which is where everybody hangs out, it's all about short term trades, P&Ls. It's the top, it's the bottom, and all of that stuff. But then if you think about it, you just think, okay, so I've got this long term trend. I'm going to put some of my capital into that. I would put 90% in, but you want to trade. I get it. So then put 50% of your capital in the long-term trend. So that's your long-term book. Leave it aside. You got your punting book, which is 10%. The middle, you say, okay, I want to swing trade. So what you can do is then say, well, if the market is skewed in an upward direction, then I'm going to buy dips and then flip out and look for the highs. Never short the highs. Why would you short the highs in the fastest appreciating asset of all time? That's just ego at that point. So then now you've got a system that is simple to explain to yourself. And then whatever indicators of using technicals you want to use, whether it's oversold RSIs or whatever indicators you use, it's really simple, because you have one thesis that the thing's going to trend over time. You've got your long-term book, you've got your short-term punting book, and the middle you can swing trade and try and capture the trend. And then you can analyze the three different books. If you're really good at what you do, stick it into ChatGPT and say, tell me about the three portfolios and how am I doing, rates of returns, risk reward, stuff like that. And you'll have a great understanding of how to improve your trading. Now, for me, I've gone completely out this end, which is like, I don't trade at all.
Yes.
I mean, I really don't. Yes, in some equity stuff, I will buy calls and stuff like that. But I'm like, I don't need to do anything. I just need to analyze the trend, how long is it going to last, and choose the best asset. Because they're all being driven by this one dominant macro factor. And this is the key to everything I'm doing right now. As I said, I used to run these broad diversified portfolios, hedge fund portfolios. And now I am ultra concentrated, irresponsibly concentrated. But it's not irresponsible because it's come from a lot of work, which is I found out that the printing of money to pay for this aging population, to pay for the debt that's been accumulating, they've had to print money, and that debases the currency. So that means there's more and more currency every month or whatever. And what that actually means is the value of the purchasing power of the currency goes down versus scarce assets, equities, crypto, housing, all of that stuff. That's the kind of dominant factor. But it's so dominant that it explains 97.5% of all the movements in the NASDAQ over the last 12 years and 90% of Bitcoin. So you've got the single most dominant factor in the history of markets at play. So you only have to look at one thing, really. The rest is noise. It's like, are they printing more currency? And therefore, it makes all the numbers go up, except really cyclical stuff, oil and stuff like that. But generally speaking, it does that. So then if everything is being dominated by this one macro variable, then all you need to do is, what is the fastest horse? And how I do that is I divide one asset by another. So I'm looking for what's going to outperform Bitcoin, because that's the benchmark asset. And that's what got me into Solana in 2022, 23. The chart pattern looked like it was going to base, and there was a good chance that was going to work. And then my switch from Solana to Sui, that did the same thing. And it's just idiot proof. All I'm doing is just looking, if everything's being driven by the same thing, by the fastest thing, that's not too far out the risk curve. That's it. And so you don't have it's going to go to zero risk with those assets because they're proven large assets. And that's the best way of capturing it. So that's all I've done. So since 2022, I've made 2 asset allocations, which is a switch into Solana at the lows, and then out of Solana into Sui. And that's it. And I've also do a bit of the punting for the fun, because your friends are you're seeing on crypto Twitter all day. I looked at every single one of those kind of highly speculative bets. They all lost money. Every single one. Some of them went to zero. The rest of the book, amazing.
Pal's pragmatic advice for navigating this volatile future centers on disciplined investment in high-quality crypto assets. He champions a portfolio allocation favoring a substantial long-term book, complemented by a smaller punting book for speculative endeavors, 10% or less. He strongly advises against shorting assets in the fastest appreciating market ever, labeling it pure ego. Crucially, Pal has refined his own strategy to an irresponsibly concentrated approach, driven by a singular macro variable: the relentless debasement of fiat currency due to sovereign debt expansion. This monetary inflation, he contends, is the dominant factor explaining 97.5% of NASDAQ movements and 90% of Bitcoin's performance over the past decade. The logical conclusion? Identify the fastest horse within scarce assets. His successful shifts into Solana and then Sui exemplify this strategy, driven by relative outperformance against benchmark assets. Pal's message is clear. In an era dominated by currency debasement, concentrating on fundamentally strong, scarce assets offers the most robust path to wealth preservation and growth, positioning investors to thrive in a world on the cusp of profound, AI-driven transformation.